What is dual income investment? Dual income investment is an interesting property strategy that has been very well received in all parts of Australia. Earning two incomes from the one property is a very appealing investment plan. In this podcast, we take the opportunity to share some information about the advantages and disadvantages of this particular strategy. A dual income investment is effectively a property that provides two incomes to an investor by way of two separate rental agreements. This may be through a duplex, dual occupancy, a granny flat, or a dual key property. Here is a summary of each type of dual income property. The duplex property. This type of property is where two adjoining residences are established on the one property. It can be two houses, two divided apartments or townhouses. Investors like to adopt this strategy as it escalates their property portfolio faster by acquiring two in one. Each side of a duplex is often designed identical to each other as the cost of materials can be aggregated and reduced the total cost of construction. A duplex property can be sold individually. This has been a popular strategy in recent times. Dual occupancy. This type of property is similar to a duplex property. It again has two properties on the one block of land, but they may not have an adjoining structure. In this instance, if the land allotment is larger, it allows to fit two large separate homes on the one plot. Dual occupancy properties generally share an entrance or a driveway. The dual key. This type of property is less common, but certainly has some demand. Dual key is where a property has one entrance, but the floor plan separates the home into two. This essentially locks off each area from one another. Each part of the home would have its own kitchen facilities, living area, etc. They may share some common areas such as a laundry or a hallway. The granny flat. This type of property is also known as a granny suite. It is part of a house made into self-containment accommodation, typically the same size as a student accommodation, normally built at the back of an existing property, as the cost is much cheaper than a dual property or a dual occupancy. Its popularity is increasing, particularly in outer suburban areas, and the fact that many Australians are now living multi-generational family-style homes, given the fact that we may have grandkids, parents, and grandparents in the one area. What are the advantages of dual income investments? Well, buying two properties in one increases your property portfolio faster, with less capital required if you bought a single titled house and land package. The maintenance costs are reduced that compared to a traditional property investment. The two incomes generated from the one block of land can be potentially higher compared to a single property on a large block of land. With both reduced cost and higher income, the cash flow can be serviced to meet the loan repayments or provide a higher income stream in retirement. What are the disadvantages of dual income investments? Potentially, tenants may be put off by the reduced privacy. Having another tenant so close may not be a desirable one for some. The floor plan may not suit the needs of everyone. For example, a family may require two living areas where the property may only provide one in each residence. The cost to build a dual income property will be higher than a standard single-storey home. The increased cost may be caused by an overcapitalisation of risk. To learn more about overcapitalisation, please explore our website under Market Insights for this topic. Some dual income properties have generated less capital growth. When addressing your objectives, you should consider what's important to you, the income or the growth, or a combination of the two. Diversification risk is higher. When developing a property portfolio, you'll discover that different locations will perform differently. One location will not outperform the property market at all times. Diversifying your location risk by purchasing property in different areas or suburbs is a good strategy to smooth out your long-term returns. Liquidity risk. When selling the dual income property, you may want to keep one of the two if the income or location suits your objectives. However, it can be very difficult to sell a dual income property separately, with the exception of some dual occupancy that only share driveways. This may cause the investor to sell both at the same time. Some dual income investments, such as dual key properties, may run on the same utility infrastructure. This may force an investor, being a landlord, to pay the cost, or alternatively, they would have to spend money to split the infrastructure so the tenant can pay and manage their own utility costs. Is a dual income investment right for me? Everyone has different objectives in both short and long term. With the exception of a granny flat, this is often a lifestyle decision to be made as a self-contained accommodation is suitably used for an elderly relative. There is a higher degree of difficulty to generate a capital growth in some dual income investments. Taking note of the advantages and disadvantages, an established property investor may add this to their property portfolio as it may complement what they already have. A first-time investor may find it more difficult. It may present an opportunity to escalate your property portfolio quickly, but the risks associated with dual income investments such as diversification and overcapitalization may generally outweigh the advantages. Before proceeding with any form of property strategy, you should always make sure you understand your situation, your objectives, and your time frame. Once these are established, assessing the most appropriate strategy will be much easier for you. We love property here at Crest Property Investments, and we do have a very clear understanding of dual investment and single standalone properties as well. If you'd like help in finding your next investment property, feel free to contact us through our website at www.crestproperty.net.au. We hope this podcast has helped you learn a little bit more about a new asset class within property. Take care and bye for now.